For most of its life, crypto lived in the shadows. Not illegal, not exactly legal, just tolerated. It grew in the cracks of the financial system between outdated laws, slow regulators, and governments that didn't quite know what to do with it. For years, that ambiguity was crypto's greatest advantage. Innovation moved faster than regulation. Founders built first and asked questions later. Investors piled in, assuming rules would eventually bend in their favor. But that era is ending. Across Europe and the United States, crypto regulation isn't just arriving, it's accelerating, and not quietly. Governments are drafting sweeping frameworks, issuing enforcement actions, and signaling something very clear. Crypto is no longer a fringe experiment. It's now a systemic risk and a strategic asset. To understand why regulation is exploding now, we need to zoom out. This isn't about one exchange, one crash, or one bad actor. It's about trust, power, and control over the future of money. Let's start with the trigger point. In 2020 and 2021, crypto went mainstream, not slowly, violently. Retail investors flooded in. Institutions followed. Pension funds, hedge funds, publicly listed companies' names that had once mocked Bitcoin were suddenly buying it. Crypto ads ran during major sporting events. Celebrities endorsed exchanges. For the first time, governments realized this wasn't just a tech subculture anymore. It was touching real people, real savings, real political consequences. And then came the collapses. Stablecoins lost their peg. Lending platforms froze withdrawals. Exchanges imploded overnight. Billions of dollars vanished. Not because of hacks, but because of basic financial mismanagement. No disclosures, no consumer protections, no safety nets. With crypto, there was nothing. So when everyday investors in the US, UK, and Australia started losing life savings, regulators were forced into a corner. Doing nothing was no longer neutral. It was political suicide. But investor protection is only half the story. The real fear runs deeper. Crypto challenges the monopoly governments have over money itself. In the US, the dollar isn't just currency, it's power. It underpins global trade, sanctions, and geopolitical leverage. In Europe, monetary stability is the glue holding very different economies together. In Australia, financial regulation is deeply tied to systemic risk and consumer trust. An unregulated parallel financial system threatens all of that. Because once money can move outside banks, outside borders, and outside reporting requirements, governments lose visibility. They lose control over capital flows, over taxation, over enforcement. And that's when regulation stops being about safety and starts being about sovereignty. Europe understood this early. Instead of regulating crypto through enforcement, European regulators chose structure, frameworks, definitions, licenses. They asked a simple question. If crypto is going to exist, how do we box it in before it gets too big to control? That thinking led to comprehensive rules designed not to kill crypto but to domesticate it. The US took a different path. American regulators didn't start with clarity. They started with lawsuits. Rather than defining what crypto is, they began punishing what it isn't allowed to be. Exchanges were targeted. Tokens were labeled securities after the fact. Rules were enforced retroactively, often without clear guidance. This created uncertainty, and that uncertainty was intentional, because ambiguity gives regulators leverage. It forces companies to comply out of fear rather than clarity. It slows innovation without passing new laws. And it keeps ultimate authority firmly in the hands of existing institutions. Australia sits somewhere in between watching Europe's structure and America's enforcement, trying to balance innovation with stability. But even there, the tone has shifted. Crypto is no longer being observed. It's being absorbed into the regulatory perimeter. And that's the key theme here. Crypto isn't being banned. It's being integrated on government terms. What we're witnessing isn't the death of crypto. It's the end of crypto as a free frontier. The Wild West phase is closing, replaced by something more familiar, more controlled, and arguably more boring, but also more durable. Because once regulation locks in, crypto stops being optional. It becomes infrastructure. And that's where things get interesting. In the next part, we'll look at who actually benefits from this regulatory explosion, why some crypto companies quietly support it, and how this shift could permanently change who wins and who gets locked out of the next financial era. And here's the twist most people miss. While crypto Twitter frames regulation as an attack, many of the biggest players in crypto quietly welcome it. Because regulation doesn't hurt everyone equally. It filters. When governments raise compliance standards, licensing requirements, capital reserves, reporting obligations, it becomes expensive to participate. Small startups struggle. Anonymous teams disappear. Fast-moving innovators slow down. But large, well-funded firms, they adapt. In fact, they gain an advantage. In the US, major exchanges have legal teams larger than entire DeFi startups. In Europe, firms that can afford compliance under strict frameworks instantly gain legitimacy. In Australia, institutions won't touch crypto products unless they're regulator approved. Regulation doesn't kill crypto. It kills permissionless crypto. And that's a crucial distinction. The early promise of crypto was open access. Anyone could build. Anyone could transact. No gatekeepers. The regulated version looks very different. Access is tiered. Identity is mandatory. Transactions are monitored. Innovation moves at the speed of approval. To governments, this isn't a flaw, it's the point. Because regulation allows crypto to exist without threatening the existing financial order. Banks get involved. Asset managers tokenize funds. Governments explore central bank digital currencies. Crypto becomes less rebellious and more institutional. And for many investors, that's comforting. Pension funds don't want anonymous founders. They want audited balance sheets, clear legal status, defined risk. Regulation provides that, which is why, behind the scenes, the loudest opposition to regulation often comes from retail traders and early adopters, not from Wall Street. Wall Street knows how to win regulated games, but there's another layer driving this regulatory surge, one that rarely gets discussed publicly. Data. In the traditional system, banks act as data collectors. They know who you are, where your money goes, and how often you move it. Governments rely on that visibility to enforce laws and collect taxes. Crypto breaks that model. Even when blockchains are transparent, identities aren't. That gap terrifies regulators. Not because everyone is a criminal, but because financial opacity weakens enforcement power. So, modern crypto regulation isn't just about money. It's about mapping identity onto blockchain activity, linking wallets to people, turning pseudonymous networks into traceable systems. Once that happens, crypto stops being parallel finance. It becomes programmable finance with rules embedded by design. This is why stablecoins are a focal point. Stablecoins look harmless, digital dollars, easy transfers, no volatility, but at scale, they function like private banks issuing money. That's unacceptable to governments unless tightly controlled. So, regulation targets, reserves, issuers, redemption rights, who can mint, who can freeze, who can censor. The goal isn't innovation, it's control over monetary plumbing. And this raises a difficult question for the future. If crypto becomes regulated, compliant, permissioned, and identity-linked, what exactly remains of its original promise? The answer depends on where you're standing. For everyday users in the US, UK, and Australia, regulation may actually make crypto safer, fewer scams, more accountability, clearer rights when things go wrong. For institutions, it unlocks scale. Trillions won't enter an unregulated market, but they will enter a regulated one. For early believers in decentralization, though, this feels like a compromise, a trade-off between freedom and survival. And maybe that's unavoidable. Every financial innovation follows this arc. It starts at the edges, grows faster than the rules, breaks something important, then gets absorbed. Crypto is simply reaching that stage now. The explosion of regulation isn't a sign that crypto failed, it's proof that it mattered enough to be controlled. The real question isn't whether regulation will slow crypto down. It's who regulation is being designed for and who it quietly excludes. Because the future of crypto won't be decided by ideology. And by the time the rules are clear, the winners may already be locked in. If you want more deep, calm breakdowns like this without hype, without noise, and without treating you like a headline, make sure you subscribe. And if this made you think differently about crypto regulation, share it with someone who still believes this debate is black and white. Because it isn't.